A credit default swap, CDS, is a financial derivative that allows an investor to swap or offset their credit risk with that of another investor. In other words, a CDS is a contract that offers protection to the buyer against default on a loan or bond by a third party, referred to as the reference entity. Here's how it works. Suppose you hold a government or corporate bond and are concerned about the risk of default by the issuer. You can purchase a CDS from a bank or another investor, commonly known as the protection seller, who agrees to compensate you in the event that the issuer defaults on its debt obligations. In exchange, you will pay periodic premiums to the protection seller. If the issuer defaults, the protection seller will make a payment to you equivalent to the face value of the bond, thereby offsetting your losses. This is the key benefit of a credit default swap, and it hedges against the risk of default. On the other hand, if the issuer does not default, you will continue to pay premiums on the CDS without receiving any payment from the protection seller. In this case, the premiums paid act as the cost of purchasing protection. It's important to note that credit default swaps are not restricted to just bonds, but can also be used to hedge against other forms of credit risk, including loans and mortgage-backed securities. Despite their utility in managing credit risk, credit default swaps have been controversial due to their complex nature and potential for abuse. During the global financial crisis of 2008, the widespread use of CDS played a major role in exacerbating the crisis. Some investors used CDS to speculate on the likelihood of default without owning the underlying bonds, thus contributing to market instability. Nevertheless, credit default swaps remain an important tool for investors
and financial institutions
seeking to manage credit risk.
when used prudently,
They can provide valuable protection against default
and help to stabilize the financial system.